Kathleen, the key takeaways from the latest reports.
Well, very important, because the Federal Reserve, for now, the outliers, a couple of months ago, started talking about downshifting to a 25 basis point hike from a 50 basis point hike. But as more and more voices have piled on, this is a very big question. So going into the meeting on Wednesday, this is what Fed officials, investors are weighing now. We saw the headline PCE deflator rising 0.1 in November, matching the previous month. It's a 5% year-over-year increase, and it was against a 5.5% expected increase. Now, the core PCE deflator, that's the one that the Fed watches very closely, in fact, most closely, up actually a little bit more on the month, 0.3 in December versus 0.2 in November. That's a 4.4% year-over-year increase versus an expected 4.7. So across the board, looking pretty good. And interesting that these final numbers for the month of December are making inflation look even less than the Fed thought it would be at the end of this year. But let's move on to the fly in the ointment. As Bloomberg Economics puts it, there's no disinflation sign at all in Powell's preferred price gauge. Let's look at that. Let's call up a little list of key factors that we have to watch here. Core services were up more than expected at 0.4%. They're hovering around 5%. And remember, services is where we see the biggest impact of wages. Wages are still running pretty hot in the U.S. That's the tight labor market. This is the Powell favorite. The PCE deflator, take out rents, housing costs, up 4.1% year over year. We consider this in a way the Fed's super core inflation gauge, as Bloomberg Economics puts it, and it's still stubbornly high. Now, on the side of, well, let's go ahead, at least downshift. Is that such a big deal? Downshift and see where things go next. Retail sales fell. The consumer spending part of this report showed weakness. No matter if you look on the monthly basis, 3 months, 6 month annualized, doesn't make any difference. That's one reason why Janet Yellen, former Fed chair, now Treasury Secretary, she is concerned about recession.
I don't want to minimize the risk of recession in the absence of further, shocks. It really comes down to the labor market. And I guess the path that I see to maintaining a strong labor market while bringing inflation down does involve a slowdown in growth.
Now, Fed officials made it very clear that if they have to hike rates so much we get some kind of recession, they will. They're hoping for a mild recession. They're hoping for a soft landing. A lot of people arguing that this opens the door wider to a soft landing. Janet Yellen just reminding us that there's another reason why the Fed may decide at least to slow down the pace of rate hikes at this meeting.
So does that mean 25 basis points is baked in?
It certainly makes it look like it's a major ingredient now, doesn't it, Heidi? That's what a lot of people are betting on. We heard recently the Fed Vice Chair Lael Brainerd. We heard Chris Waller at the Board of Governors, who has been one of the early ardent voices for hiking rates aggressively, continue hiking. But in a couple of recent speeches, he too has opened the door to, gee, maybe we've done enough, or at least enough, so we can slow down. The thing that's going to be in focus now, besides whether or not they've downshifted to 25, it's what they see next. Markets already pricing in a series of rate cuts in the second half of the year. Will Powell come out with his, hey, we have to stay tight, we're going to keep that key rate high until the end of the year at least? Or will he open the door a little bit wider to sooner rate cuts, depending on what the economy looks like over the coming months?